With that, just to introduce then our first guest of this year is David Harrison, who's a London-based lawyer and a former diplomat. He was an undergraduate here in Oxford and obtained his law qualification at the University of Exeter in the west of England. His early career was in the civil service on the economic side of the Foreign Office. He worked in a variety of EU economic, financial policy questions, including having postings in the UK permanent representation in Brussels and the British Embassy in Paris. He was a speechwriter for the Foreign Secretary. Since 2002, he's been working in private practice, specialising in competition issues regarding the EU. He's published widely in competition law and related subjects, including in 2014 a book on competition law and financial services. And today he's talking about his latest book, which is Price and Financial Stability, Rethinking Financial Markets. So we'll be talking for 30, 40 minutes, and then question and answer. I remember to say this time that the talk itself is on the record, and then questions and answers afterwards, it's Chatham House. So over to you, David.
Thanks very much, Charles. Firstly, nothing I'm going to say will, I think, shock anyone, but I should emphasise I'm speaking personally. I'm not speaking on behalf of my employer, which is a law firm based in London. Charles just reminded me to say that earlier on. I'm going to first just explain why the book that I've got coming out, why I wrote it. Secondly, to talk a little bit about the theoretical background of the book, which I think I need to explain. Then explain where the theory leads me in terms of the practical proposals in the book. And then finally, I've suggested half a dozen what seem to me open questions or points for discussion or points for debate, where I very much welcome other people's views, because I think these are enormous subjects, and I by no means have the monopoly of wisdom. Firstly, why the book? I mean, it's probably strange that a lawyer should be writing a book about price and financial stability, with rethinking financial markets. I spent quite a good part of my career as a lawyer in competition law, which, as some of you might know, is the law that applies to essentially the European single market. It's similar in the US. There's not radically different. Most developed countries these days have got some form of competition law, and it's the law that applies to essentially maintain competitivity or competition in the what you might call the real economy. And so I spend my day-to-day life advising firms on how not to fix their prices, how to not abuse their dominant position, and it derives ultimately from the European treaties, and it's then devolved down into national administrations or national jurisdictions, as in the case of the UK. I published a book which I wave around here, which is Competition Law and Financial Services, which is a rather technical book for competition lawyers looking at the operation of financial services a few years ago. And it seemed to me in writing that book and then thinking about it afterwards that there were other questions which then arose. And the points which I kind of left open in that book, I'm now bringing forward and looking at in more detail in Price and Financial Stability. And just to sort of summarise my starting point, so you know where I'm coming from, it just might make it simpler. I generally adopt the Charles Kindleberger thesis that since the end of the Bretton Woods system, that we've seen a series of financial crises which are almost like sort of rolling earthquakes, which sort of shake the economic and financial and political structures of the countries concerned, going back to the oil price hike of the 70s, then the Latin American debt crisis, then the Japanese debt bubble and crash, the Nordic debt crisis, the Southeast Asia crisis, then the US subprime debt crisis, the global financial crisis, and the Eurozone debt crisis. I cover these in Price and Financial Stability, but I think everything I've got to say about this has been said well by other people in other places. These crises seem to be serious. They don't just put the economies under stress; they put societies and indeed open societies and polities under stress. And they do, because of this stress, these stresses that they put on societies, create the temptation of autocracy. I also adopt, just for the purposes of the book, something which you can find in Hyman Minsky, but Minsky gets it, I think, going back to Keynes, which is that really there are two different price systems in the market economy. We have one price system for the current output of goods and services made by companies, firms that are put by producers on the market when they need to recover their costs. And this is, in shorthand terms, I just call the real economy, and this is the sort of competitive market that I deal with on a day-to-day basis as a competition lawyer. And it seems to be relatively stable. It sometimes goes wrong, but it doesn't go massively wrong. And then there is a second price system for the values placed on future income flows from outstanding financial and capital assets. And Minsky makes this distinction in his works, and you can trace it back to Keynes and the general theory as well. It's a little bit ambivalent in the general theory, but the roots, I think, are there. So I've got this sort of two-price system model for the market economy. Another point of departure is I accept Keynes's stress on the impact of radical uncertainty on investment decisions as taken by firms really investing in the real economy. I accept fully what Keynes says there. I've just added to that a further angle, which is that it seems to me that although Keynes is right, and there is radical uncertainty around, it's not unique to finance, and it's not unique to the world of economics. We can actually look at other sciences, social sciences and physical sciences. And I've borrowed Karl Popper's approach here. Karl Popper is the preeminent philosopher of the theory of knowledge and how scientific knowledge is created. And I asked myself, can we apply Popper's approach to dealing with uncertainty and openness to economics, to the world of economics? And although Popper didn't do so to any great degree, Popper always argued that there was in fact a unity of method, or there should be a unity of method between the physical and the social sciences. The two were not really distinct, and they were approaching problems in the same sort of way. So that was the starting point that I used for the book Price and Financial Stability. So going on to the sort of theoretical approach that I adopt, I go back to Popper again, back to Karl Popper. And in Popper's sort of view of the way in which knowledge is formed and created and improved on, he plays a great stress on the role of expectations. And Popper sort of argued that really expectations are some things which are common to all, they're common to humanity, but they're common to all living organisms. It's a sort of biological function of being alive. And he sort of said that actually most expectations are inborn, they're just inbred, you can't do anything about them, they just depend on where you are in the evolutionary niche, and they result from your place in the world. And some, though, are based on experience. So there's a mixture, an expectation, some based on who you are, what sort of animal you are, and some based on experience and particularly previously observed regularities. Now, in Popper's explanation of scientific knowledge, it's the testing of expectations, these expectations, wherever they come from, which leads to the growth in knowledge. And according to Popper, scientific knowledge is the best and the most sophisticated, but not the only form of knowledge, because scientists, in the best way, can create falsifiable theories. They can create theories which express their understanding of the universe. And what's good about them is that those theories can be tested by argument and critical discussion amongst other scientists. And that's what he meant by falsifiable and testable. And so although scientific theories are the best, they're not perfect, they just happen to be better than other forms of knowledge. And at every step, you're testing, through a trial and error process, your expectations, your ideas, your conjectures, against reality or against argument. Popper, I said, look, it's not just human beings that have knowledge, animals have got knowledge too, and he thought possibly even plants have got knowledge. because they adapt themselves to their ecological niche. And Popper used to say that really from the amoeba to Einstein is only one step. And both use the method of trial and error. And the difference being that when the amoeba gets it wrong, the amoeba dies. When Einstein gets it wrong, his theory dies. He can adjust his theory, but Einstein survives. So there's a sort of continuity of approach there. It's quite a nice sort of explanation of the growth of human knowledge. Now, in Keynes's general theory, to move into economics, there are two types of expectation. There are the short-term expectations of the producer, the manufacturer, selling his current output on the market. And then you have the long-term expectations of the producer who wants to add to his capital investment through the investment process. And according to Keynes, short-term expectations vary gradually. They're sort of updated in light of realized results. You sell something, you change your expectations about the price of something, what your equipment can do, and you can adjust it in the light of sales on the market. Again, according to Keynes, long-term expectations, which are the expectations relevant to investment decisions, are subject to sudden sharp revisions, much more discontinuous, go up and down, vary enormously. And so it seems it's quite interesting to sort of put this into a sort of Popperian perspective, and you can see that short-term expectations are testable by a kind of Popperian trial and error method, and through the price mechanism, the producer can adjust his outputs to the purchases of people who buy from him, and this price mechanism, according to Hayek, distributes useful knowledge around society. And when Hayek talks about his telecommunications system, which allows producers to kind of automatically, sort of upgrade themselves in the light of signals they receive from around the world, I think he's really talking about producers. And I've looked at sort of Hayek's thing there, Hayek's message, his essay from 1945. And in this sort of short-term expectation world of the real economy, competition policy, which I deal with a lot, protects this form of signalling, this sort of price signalling mechanism, by ensuring that competing producers, for example, can't coordinate their price signals between them. They can't fix their prices, they can't agree prices between them through cartels. If they do that, that's unlawful. So competition policy today insists on and protects the decision-taking independence of companies, producers, putting items onto the market for sale. And they each have to do it independently. There's got to be, otherwise they're at risk of breach of competition policy. And this seems to work reasonably well. I mean, it may be, one might be able to perfect it more, but it's that is the way that sort of real economic competition policy operates. Now, long-term expectations, which are the subjects of chapter 12 of the general theory, are much more of a problem. And Keynes argues that in the face of an uncertain long-term future, it's the revaluations of the existing stock of capital, of equities, through the stock market, capital markets, which has a decisive influence on new investment decisions by companies. But this is really not a direct pricing mechanism. It's a proxy pricing system. It's a sort of backward-looking pricing system almost, and it's not equivalent to selling items to purchasers in the short term. It's a sort of almost a kind of backward-looking sort of proxy price system for investments. And also, and crucially, as Keynes argues, in liquid investment markets, those whose business activity is forecasting the psychology of the market, which Keynes conveniently calls speculation, tend to prevail over those attempting to make reasonable estimates of the yields of capital assets, or the streams of income you get from investing in a new capital assets, which Keynes calls enterprise. And Keynes said that they don't necessarily, speculation doesn't always drive out enterprise, but the bigger the market and the more liquid the market, the more likely it will be. It will do so. And he cited the example of Wall Street in the 1930s, where many investments, when many trades took place with the intent of overturning them within 24 hours. And he said, yes, this is a good example of how speculation dominates Wall Street. And that was in the 1930s, and that was a long time ago. If we then look at this problem of long-term expectations, problems of dealing with uncertainty of the future, and the tendency of speculation to drive out enterprise in Keynesian terms, through the lens of Karl Popper again, I argue that trying to forecast the psychology of the market and see where the market is going is very similar to what Popper described as a pseudoscience, because it's impossible to make repeatable, falsifiable forecasts. It's rather like a sort of myth or a legend. I mean, Popper talked about a lot of psychiatry as being, Freudian psychology as being like a pseudoscience, because it's actually very difficult to make forecasts and scientifically testifiable predictions. And in the in stock markets driven by speculation, they're always adjusting, always shifting, always rolling forward untested expectations, because the expectations are not tested in the way that short-term expectations are. And this is what Keynes talks about when he talks about the market's result being effectively anticipating what average opinion expects average opinion to be. It's a kind of psychological phenomenon, and it's very difficult to get a handle on it and work out exactly what average opinion will think average opinion will be at any one point in time. And it just moves forward in a rather sort of erratic sort of way. However, by contrast, it should be quite possible to make testable or falsifiable forecasts of the yields of capital assets, which are simply the streams of income you get from either holding or investing in a new capital asset. One method would be just to wait and see what the yield is over the long period of time. I mean, that sort of seems quite possible. Another would be to work out what previous yields of similar capital assets have been in the past. Many capital assets are quite similar to each other, and they tend to repeat themselves. It seems, strangely, that in fact there is evidence that there is a long-term stability of returns on capital assets over the long term. And in Piketty's book, he talks about how in France and in the UK since the 18th century, the actual long-term returns on capital are actually pretty stable. They run at about somewhere between 4% and 6% per annum in real terms, year in, year out, depending on, almost irrespective of the actual capital asset in question. Anyway, I sort of posit this kind of Popperian way of dealing with this problem of Keynesian uncertainty by saying, yes, it's true, you can't actually predict the psychology of the market, but perhaps you can, if not actually formally predict, but make reasonable estimates of yields of capital assets. So Keynes' stress on uncertainty of the future might be a little bit misleading, in the sense that he's quite correct that I'm sure that long-term investors are in a minority in speculative liquid markets. But it's probably incorrect to say that actually estimates of yields of capital assets are intrinsically impossible. And faced with an uncertain future, as is always the case and applies in every other science, the normal method of making testable forecasts should be possible. And in the general theory, Keynes sort of suggests that the state should step in and have a role when talking about, when trying to deal with long-term investment to sort of display, because of the uncertainty of investment markets. Another possibility might be a neutral party or a regulator as opposed to the state, but I just put that as a thought. But whatever the answer, it seems to me there's a sort of gap in theory. And today, it seems as if long-term expectations which relate to investment and also increasingly the allocation of collective savings to investment, seem to be missing a sort of general useful workable theory of the likely streams of income from capital assets. And as a result of this kind of gap in theory, fluctuating current prices in liquid investment markets predominate. But unlike short-term current output real economy prices, these prices in liquid investment markets don't really distribute useful knowledge. They just distribute the current expectations or opinions of those in the market. Those opinions are untested, or relatively untested, against reality, and they shift and they move. And really, it's rather like a sort of pseudoscience. And I mean, George Soros called his book "The Alchemy of Finance," and alchemy is a pseudoscience, and I think that explains why he called it. So that's the theoretical approach that I take in the book. The practical consequences seem to me as follows. Firstly, in liquid financial markets, a high proportion of activity does seem to be what Keynes called speculation, or forecasting the psychology of the market, or attempting to forecast the psychology of the market. Sorry. And this is despite thanks very much. This is despite the post-war institutionalization of investment, which Minsky calls money market capitalism. Money manager capitalism. And this institutionalization has increased enormously and is likely to continue in the future. Jack Bogle, who's the founder of Vanguard, currently the world's largest mutual fund, describes how in the 1950s he assumed that the rise of institutional investment in the US would promote Keynesian enterprise over speculation. In other words, that institutional money managers would focus on long-term yields as opposed to speculation. But he said, I got it completely wrong. Speculation just took over, and enterprise is nowhere. Stock trading volumes have massively increased since the 1950s. Holding periods shortened. US mutual funds, according to Bogle, have been turning over the portfolio about once a year since 1985. And it was Bogle created the equity index fund as a counterbalance to this trading mentality in the mutual fund world. And it's interesting how, even having done that, you then have exchange-traded funds based on indices, which then themselves become traded in liquid investment markets. So it seems it's almost a kind of never-ending arms race. You create some new investment product, somebody else will create something which you then trade against that, and then it will go back to trading again. So this kind of battle, which is in the general theory between speculation and enterprise, just seems to repeat itself again and again and again in whatever liquid market you care to mention. Relatively little new investment capital for real companies seems to emerge from this process. Bogle calculates that in 2011, about 1% of the volume of US stock trading actually consisted of new capital, or was equivalent to new capital for US companies. The 2012 John Kay review of UK equity markets described, it was an amazing thing, but he described UK equity markets as being a means of getting money out of companies rather than a means of putting it in. Michael Porter, a long time ago, in 1990, in The Competitive Advantage of Nations, which I was looking at actually recently for some completely different reason, describes then how diminishing levels of corporate investment in the US and the UK since the 1970s could be attributed to short-term financial markets valuing share price appreciation over long-term yields. And Porter wrote in 1990 that in American companies, rate of return targets used to screen investment opportunities are the highest of any nation we studied. And that was a long time ago. There seems to be a parallel problem in the creation of credit by banks. I mean, not exactly the same, but parallel. A high proportion of credit in the developed world is extended against property as a capital asset. Once sight is lost of the underlying yield, the reasonable underlying yield of property as a capital asset, which you would normally measure in terms of rental income from it, current prices will take over and banks will overlend collectively in anticipation of price appreciation. If enough banks do this collectively, the credit fuel process will then increase prices. Prices will increase until the supply of credit will stop, as it will at some stage, creating a credit bubble and a crash. And we've seen many examples of this in the post-Bretton Woods world. Foreign exchange markets, just to take a third example, do seem to be driven very largely by speculation in the interbank market rather than by the requirements of real companies. And this has increased since 1971. What actually drives currency movements, it seems to vary from time to place, but expectations and interest rate changes and differentials between interest rate changes of issuing countries seem to be a very significant factor in the foreign exchange markets. So the practical recommendations that I sort of come to in the book on the back of that theoretical approach and analysis of the world we seem to live in is it seems to be that there's actually little chance, I mean they may, but there's little chance of speculative markets correcting themselves, that markets driven by Keynes's speculation, trying to forecast the psychology of the market, are unlikely, to put it mildly, to come into balance. The reason being that in the face of an uncertain future, it's usually easier for the majority to go with the psychology of the market, to follow the market, than to attempt to stick to forecasts of long-term yields, or in the case of foreign exchange, currency markets, the actual economic fundamentals of the issuing country. Keynes called this propensity a conventional basis of valuation. So you go with whatever the convention is at the time, and because of this tendency to stick with a conventional basis of valuation, because it's safer than the other, this creates a risk of financial crises repeating themselves. So when we then get on to, so what do you do about it? How you deal with the problem is the difficult part. It seemed to me that it would be a good idea to have a new public policy good of promoting relative asset and financial price stability as a standard to guide fluctuating expectations. So what would that be? For capital assets, the underlying yield of the capital asset would be the yardstick you'd use. You just say where prices depart, perhaps seriously or significantly or overmuch, it might change over time, but where they depart from the underlying yields, they need shifting or nudging back in line somehow. There's something wrong there somewhere. And I would apply that to stock prices, which are valuing industrial capital assets, and also property, principally commercial property, when current prices depart from yields, usually measured in terms of sustainable rent income. Currencies, there isn't a kind of yield as such, but I would simply just go back to a more stable currency system as in Bretton Woods. How would you implement this kind of methodology? I would, I think, just use the existing Bretton Woods global framework, but with decentralized responsibility to central banks, but not just central banks, to financial regulators and also competition authorities, to promote asset or greater asset and financial price stability in their jurisdictions. So decentralized approach might vary from jurisdiction to jurisdiction, but you have a sort of general global policy objective with IMF oversight to aim at greater stability of financial and asset prices. For currencies, foreign exchange currencies, I would revive the IMF Article 1 duty to promote exchange stability, to maintain orderly exchange arrangements among members, and avoid competitive exchange depreciations. Now, you can do this either formally or informally. Robert Mundell talks about informal cooperation between the three major currency zones of the Eurozone, the dollar and the Chinese yuan. And that might be the simplest way of doing it. I mean, we can come on to that later on. For asset prices, under general IMF Article 4 oversight, with the IMF responsibility for overseeing the continuing development of the orderly conditions that are necessary for financial and economic stability, I would simply say central banks, financial regulators and competition authorities should be charged to promote stability according to local conditions. So for central banks, this would mean building on their existing mandates to maintain real economy price stability, low inflation in the real economy. So they would add a little bit to their mandate, but I accept that central banks will say, well, this is going to be too difficult for us. We can't, it's too much asking us to look after asset prices is too complex, and I think it probably is. And you can't just through monetary policy. This may be asking too much. But financial regulators have a mandate already to promote financial stability under the Financial Stability Board, and I would simply add to their mandate that would include asset price stability or reasonable asset price stability. Competition authorities, they have a mandate to keep markets competitive and so prices stable also in the real economy. And I would then just develop that more into the financial economy and into financial services. And I have a chapter on how to do that in a bit more detail in the book. So all of these would involve adding to and amending, but not radically changing existing mandates, but taking them a bit further forward and under a more of a sort of unified global policy position. I mean, the obvious kind of counter-argument is that, aren't you meddling with the markets here? Isn't this awful? Isn't this kind of sort of socialistic intervention in the freedom of the financial markets? And to which I think the answer is the objective really isn't to sort of stabilise prices so much as to stabilise expectations before they crystallise into prices, because expectations are sort of upstream from prices. If you don't do this, the evidence is that expectations seem to feed off each other in speculative markets and kind of bounce and ricochet off each other through feedback effects because they're insufficiently tested themselves. So in the absence of this, you will have a continuing cycle of booms and busts and crises. And therefore, I think there is a role for some public body to say, look, these expectations are unstable, they need to be brought back into line in some way. Keynes in the general theory talked about the need for a far-reaching change in the psychology of investment markets, such as there is no reason to expect. So I'm sort of citing Keynes again, and that's why I think you probably do need to do something rather than allow it to sort itself out. I'm just going to conclude by listing half a dozen what seem to me sort of open policy questions where I very much welcome comments and thoughts and suggestions. Firstly, competition policy itself. The problem, it seems to me, is this originated in heavy industry, coal and steel community in the UK, antitrust policy in the US, and there's genuine difficulty in applying competition policy to financial services. And I've got two suggestions in the book in a chapter on this. One is to treat banks not as competing companies in the same way as other companies, but to treat them more as an interconnected network industry. Going back to, in fact, Keynes' treatise on money sort of does so to a certain degree, which is prone to move collectively through sympathetic movement in the money creation process. Almost a kind of internal sort of signalling process within this collective industry, this interconnected network industry. And the problem, it seems to me, is not so much in any individual bank doing something crazy. It's more when lots of banks do crazy things all at the same time, and they sort of seem to find it irresistible to move collectively into a bad position. Now, one competition policy solution is then to reverse the policy burden of proof, which you can do for network industries, and say that competition law can be declared inapplicable provided that the collective behaviour has real economic benefits. And you can do this in other industries where you've got sort of collective behaviour, which you kind of disapply competition policy, but you say only if it has economic benefits. And if it doesn't, then sanctions can be applied. And that might be a way of dealing with the overextension of credit against appreciating capital asset prices. For asset management, which is growing bigger all the time, collective institutional investment, I'd encourage the movement from short-term speculation to a yield-based investment, as in the interests of captive end savers, because there's a principal agent issue at stake there. I think competition policy could help there, and the Financial Conduct Authority is carrying out a market study into the way in which the sort of principal agent relationship between fund managers and savers who have no choice but to save through them. And in both cases, I think competition policy could actually help price stability. So that's I think there's hope there. Second area, this may be a bit specialised, but the marginal efficiency of capital in the general theory consists of one, a known supply price of the capital asset, then two, the uncertain prospective yield of the stream of income through the whole life, like a series of annuities of any given capital asset. And Keynes said it's the enormously wide fluctuations in the market estimation of the marginal efficiency of capital, too great to be offset by interest rate changes, which contribute to booms and busts. So, question, would asset price stability dampen booms and busts? And might it also make actual company investment decisions easier because less uncertain for the long-term future? A third sort of question is whether you could actually do something with yield-based investment in the real world. And I have a chapter in the book on how potentially one might set up a European long-term capital market aimed at matching the long-term investment needs of European companies with the long-term, well, very high savings rates in Europe. I think we could also integrate that with a better planning of public and private investment at a European level to promote growth. This obviously links into sort of Eurozone reforms and the future of Europe. But this seems to be an immensely more fruitful and interesting topic than Brexit. A fourth area, a question which I asked myself actually when I was writing the book: do we really need a new Bretton Woods? Well, I'd be interested to hear any views on this. The IMF Articles of Agreement still provide for international currency stability, orderly financial conditions, a monetary system that does not tend to produce erratic disruptions, and reasonable price stability. So, do we actually need to really change the current arrangements, or can we use the current Bretton Woods system and tweak it and amend it slightly to provide greater global stability, or do we need something completely new? It seems, my own view is that since you've got a treaty in place, it's very difficult to get new treaties agreed and then ratified. Perhaps it's easier staying with what you've got and working with what you've got than having something completely new, but that's just a personal view. Fourthly and fifthly, well, fourthly, if you're going to have currency stability, what's the best denominator for currency stability? If you assume some sort of greater central bank corporation based on some common denominator for intra-central bank money, what should it be? Should it be gold? Well, gold seems difficult because it's formally excluded through Article 4 of the IMF articles. What about Keynes's bank war again? What about a basket of commodities? What about special drawing rights, comme dessus? Or even Robert Pringle's idea of using real capital, real assets, the idea of using capital assets as a monetary standard measured in terms of a fraction of global equities. So then money becomes a sort of an equity stake in the productive economy. How fixed or adjustable should currency stability, how should it be, and over what sort of timescale? So what does IMF Article 4 mean when it talks about stable but adjustable exchange rates, and what is orderly in exchange arrangements? So I think those are all completely open questions. I don't have an answer, but obviously they are crucial. And my final thought is really, it seems to me that all this would make a great European initiative, and would not a more stable global monetary and financial system be a worthwhile European objective? The risks of global instability seem evident since 2008. So why not build on European monetary union by firstly improving investment conditions for savings within Europe, so more savings going into more productive investment, And then secondly, aiming to create a more stable external monetary and financial environment, less crisis-prone and more conducive to trade and growth. And again, I naively think that actually this is all rather more useful than Brexit. I will conclude on which note.
Thank you.